Hi, I'm Ethan Devitt. It is Wednesday, April 9th. This seems like it's becoming a habit, but this is another special happy hour podcast. It seems that even in the last 2 days, news flow has moved on, and we're now discussing in an even more nuanced way some of the challenges that we discussed on Monday, particularly around the movement in US Treasuries. So again, I'm not sure we'd really call this a happy hour, but what it is time to really reflect, digest some of the news flow we're seeing, talk about it a little bit, and try to give some reassurance as to separating signal from noise and just making sense of the various volley of news items that we're seeing right now. So sharing the screen, I'm calling this upping the ante, as it's certainly the case that in the last few days, the trade war has upped the ante. There have been an increasing level of tariffs, particularly against China. We've seen retaliation from China, most recently to 84% tariffs on their side. And we are seeing an increased strong rhetoric from all sides suggesting that this is not something that is going to be put to bed so easily. And certainly retrenchment from this position could be increasingly challenging for President Trump. We're also going to discuss expectations. We've seen expectations come a little unchained when it comes to inflation expectations as well as growth expectations. That's all happened in the last 48 hours. We'll talk about that and wonder whether we are overcorrecting in the light of some quite dominant news flow. And then we'll ask, are we still okay? And I'm using this as a slight pun. The K I'm referring to is the K-shaped recovery that I've spoken to about some time. If we think about the shape of the K, we have the higher earners on the upper end and the lower earners on the lower end. The lower earners have tended to have a downward trajectory, while higher earners have had an upwards trajectory. That has persisted since COVID. It has certainly persisted since the last recession fears. So we're going to look at different earners and how the current situation in markets is affecting each of them. And the punchline is, spoiler alert, that it's actually been going to be pretty difficult at every part of that K, at least in the near term. What have we seen so far? We have had a very volatile whipsawing market. That was the case on Monday. We had a fake news headline around zero tariffs, or at least a concession on the part of Europeans that caused markets to rally. They ended a little bit negative or slightly positive, according to which index you look at, but certainly not the wipeout that we were expecting as Black Monday. We have seen, though, that as the rhetoric has hardened and as some of the retaliation has accelerated, that we have seen that this rally has been squelched. We've seen that this was April 8th, so yesterday's trading, 104% tariff on China made official. That is essentially doubling the price of Chinese imports, doubling the cost of the dollar store suppliers that provide low cost groceries into particularly the lower earners. So very seismic change there, and that markets have reacted in kind. We can also see that this has been the biggest 4-day loss since 2020 by the S&P. So quite a bit of volatility. Markets have proven they are highly reactive to news flow, even intraday in this case. And stock trading volume has been spiking. We have heard, as I mentioned at the end of the last podcast, anecdotally, that there are inflows, that retail investors are looking to buy the dip. That is an interesting phenomenon. I think it reacts, again, is showing the reaction, the muscle memory to the buying of the dip that we saw, to the sense of FOMO, to the sense that the only game in town was high growth equities. If that's the case, and it is retail investors, but not institutional investors, that would give me some concern that this is not necessarily driven by fundamentals and maybe, as I said, muscle memory and trading reaction. But we can see that trading volume has spiked, both inflows and outflows there. When it comes to China's retaliation, we've seen a fairly strong position by China. The sense that initially President Trump said that was a panic, that they were retaliating, but they said that they will stay the course in this. And we know that one tool that the Chinese have to offset tariffs is to weaken the yuan, weaken their currency, so that they're essentially, even at double the price, at double the tariffs, that what they supply into the US does not actually cost more in dollar terms. There is a limit to how much they can do that. They cannot completely wipe out their currency, and we can see that there's already been quite a bit of intervention there. Whether the yuan has weakened to a record low, we don't at this point know whether this will be enough. It probably will not be enough to offset the effect of the tariffs. So we can see that there will be some brinkmanship going forward as we see what happens here Another point has been raised as to whether this is even a credible rate of tariffs. 104% in the one case in the US, 84% in the case of China. Is this something that is sustainable? And the question, and we've said this before relating to central banks, when governments or central banks or other institutions do things that are not credible, and when markets second guess them, and we saw this in the UK in the case of trusts and trust economics, we saw that when markets second guess governments and actors, it is not a good thing in terms of market confidence and market certainty. And we can see that if there is a sense that these tariffs simply are not sustainable, they can make no sense. It will essentially, I spoke about an amputation of one limb with respect to trade before. If these tariffs are so high, they would effectively freeze trade entirely. And whether that is a sustainable situation in the short term or medium term, if that is the case and it's simply not credible, then we will have a massive loss of confidence among equity owners and market participants. So very much needing to focus on sustaining credibility. And that is something that the US Fed is trying to do, but it has been a little bit of an uphill battle, as we'll show just in a minute. Now we've seen Treasury yields entering the chat. What we said on Monday was that the interesting thing in the flight to safety was that we had Treasury yields in the US 10-year moving below 4%. This did, on one level, seem like part of a grand plan. We know that Scott Bessent has spoken about focusing on this 10-year yield, focusing on keeping that low, not necessarily focusing on the short-term Fed funds rate. We had a lot of commentators suggesting that keeping that low was a genius move in that it would lead to lower rates of interest on the burden of US government debt, would help homeowners looking to refinance their mortgages, and would equally help with businesses looking to refinance their debt. You can see now that that was quite a short-lived situation, that demand for bonds, the safe haven nature. I spoke before just now about credibility, confidence, and we know that when there is no confidence in a sovereign or in a currency, there is tend to be a flight from bonds. And we've seen a dramatic move in the Treasury yield, the 10-year and the 30-year, just in the last few days. And the sharp 2-day sell-off has raised speculation about who is selling. There has been some speculation that the selling has come from China. I've seen some statistics suggesting that Chinese holdings of US long-term treasuries is actually closer to 12 or 15%, down from the 20+% that they would have owned before. They have been diversifying their holdings. I don't think that we can attribute all of this sell-off to China. There may be some collateral issues and some deleveraging occurring in the hedge fund space, or some flight into other safety assets such as gold. But this has actually been a pattern that we're seeing around the world in terms of a sell-off of long-term government debt. The other question is the safe haven status now of treasuries. In the last few days, we've seen treasuries go from being a safe haven to being sold just like other equities. And the other aspect that has been sold has been the US dollar. There is a lot of discussion that this US dollar safe haven status really went hand in hand with the US's leading position in global markets and global trade, that it could not be severed from that. And as the US seeks to impose its isolation, its verticalization, that it would be only natural that the US dollar loses its reserve status or loses its safe haven status. And we have seen the dollar being sold off, that there's a sense that, is it secure relative to what other currency? There's been a little bit of a floor there, because we know that other currencies aren't necessarily as popular either. But the sense that the dollar may no longer be a safe haven, that has been another development just in the last few days. And then when it comes to what is a safe haven today, or where is it good for investors to park cash, just let's step back a little bit to look at the backdrop. We know that the ECB was cutting rates. They had 6 rate cuts. They looked poised, thanks to low inflation numbers, to do a 7th. So that was not necessarily supportive of the euro. We did know also that the dollar, because the Fed was pausing and data dependent, that that there was no sense of rate cuts coming, at least imminently, in the US, so that was likely to support the dollar. So that rate differential was supporting the dollar and also making US Treasuries an interesting place to stash cash. Strong dollar, solid return, good real return as inflation was low, and it looked attractive for non-US investors. Now we can see that the German 10-year yield is actually higher than the US 10-year yield, building in the hedging costs, so that it could be the case that we see fewer natural foreign buyers of US Treasuries, as other safe havens look attractive. So that's another technical factor which could press the price of US Treasuries down. The Fed's dilemma, and we have seen a little bit of a shift in the rhetoric from the Fed already. We know that just a few weeks ago, they were just discussing the effects of tariffs being transitory in terms of inflation. Now that tariffs look to be a lot higher than anyone had expected, they're suggesting that they're not transitory and that they are likely to be more long-lived. They've focused on that. And if we'd also look at the impact, the direct impact, some analysis in the Wall Street Journal that China's tariff rate would have on CPI, it would have basically direct flow through into CPI, suggesting that even 54% could increase US CPI by 0.35. That would push it close to 3% based on current levels. And equally, that 104% tariff rate would lead it to rise by 0.67, so in excess of 3%. So direct flow through of tariffs on China alone into US CPI. And what we can see in this chart below, produced by University of Michigan and Bureau of Labor Statistics, is a step up in expectations of inflation. 5 to 10 year rates have now become the highest expectations since 1993, whereas payrolls are still high, of course, meaning if we remember that a strong employment picture does push up the cost of labor, does increase that as a cost push factor. So the Fed is facing a little bit of a dilemma in that it now knows that inflation expectations are ticking up. It would not normally want to cut rates into that. But equally, we have the president clamoring for rates to be cut. And we know Scott Bessent is focused on lower rates at the 10-year end, and equally some economic strife on the horizon. So the Fed does have this dilemma. It's dropped its transitory language, but it knows it needs to retain its credibility. So if we think about the K, this inflation expectations are directly going to affect the bottom of the K. Again, the bottom of the K that has not done well post-COVID and in the recent years when we did have recessionary fears. We also look like we're having some problems at the top of the K. So the highest earners. We've seen some of the most staunch supporters of President Trump come out against tariffs, against his policies. We've seen Bill Ackman tweeting furiously, suggestions that some hedge fund was in some stress, Renaissance in particular, having already seen an 8% downturn in April. These hedge funds would have been levered, and that, of course, exacerbates the losses. There's also a suggestion that now some of the big bank CEOs and other CEOs of tech companies are a little on the back foot with the recent tariff movements. They have courted President Trump since his election, and we're hoping that might translate into influence. It seems that there has not been an open channel of influence, or listening at least, to some of this pushback at this point. And many of these erstwhile supporters of President Trump may be somewhat stranded in this case. So again, the top of the K, not necessarily looking at a particularly buoyant at times at the moment. And remembering this is also where the lion's share of the wealth and equity markets is held. The ongoing backdrop to all of this is that we're also seeing the Doge austerity continue to wield the knife in the background, even though not on the headlines. We've seen additional freezing funding for universities, Cornell and Northwestern, the latest, over $1 billion in cuts discussed there. And this comes on the back of many other similar Ivy League institutions being in the crosshairs of the Trump administration. This has devastating impacts on science spending, research grants, and really the cohort that is probably closer to the middle of the K. So they're neither at the lower end of the earners nor at the top end, but it's education, it's science spending and other research that has been affected too. So we're really seeing a lot of this occurring. And I would also put federal workers at the middle part of the K. We've seen dramatic headcount cuts there. They're not neither top nor bottom earners, but they are in the middle, and this is likely to also be some strain for them. So where do we go to from here in a portfolio? We know in the past that when there has been a crisis, and we've seen this during COVID, we saw this in 2008, we have been able to rely, sometimes mistakenly, for the long-term safety, health and safety of the population, on the U.S. government or a government to bail out the public, or to work furiously behind the scenes to ameliorate the effect of a financial crisis. We certainly saw this in 2008 when the government worked furiously to shore up the auto companies, shore up the banks. We saw this during COVID with the checks being paid out, as well as furlough payments that were in place when workers could not go to work. The safety nets in this case, it's not easy to see where they're coming from. We have not yet seen the tax cuts that were promised. And as I mentioned, we are not seeing support coming in other form of government payments. If anything, many are being rejected. We could argue that in Europe and elsewhere, those governments, by retaliating, are in effect casting a safety net for their citizens and their economies, because they are forced to retaliate if their own exporters are being targeted in this way. So arguably, there are still safety nets, perhaps not as obvious here in the US. It's also, we've seen multiple charts on this. I think it's worth reiterating that trading around this volatility may well be futile at this point. I showed a chart showing how volatile markets have been. Getting really in the vortex of that volatility would be extremely difficult for a retail investor. We do know also, pulling the lens right back, that the markets have generally do recover their losses and will when uncertainty eases, will be in a positive place. So if investors can stay the course and not react too much to take action in the circumstance, it is worth remembering that. I think we've seen lots of rhetoric around the widespread holdings of equity among the European and the US citizenship, particularly, say, public servants, and the fact that their pension plans are also invested in equity markets. It's important to remember that defined benefit plans are just that. They are defined benefit, despite the fact that they are invested in equity markets, and the plans themselves will see volatility. The benefits themselves have a guarantee, have a covenant, and they should not be at risk. Defined contribution plans, where the investor themselves determines the allocation and investment, they are at risk, and they're very much going to suffer in the current volatility. But I would again stress, these are long-term investments, the importance of staying the course. Finally, there's been quite a lot of discussion on uncertainty recently. And I would say that it is true that uncertainty does become resolved over time. It always seems that when we're most in the vortex of the uncertainty, that there is no way out and it will never end. I would say that we've seen this during COVID. We've seen this in other crises. The actual pain points can be quite concentrated, brutal, but concentrated and short. And no matter the uncertainty we're seeing now, maybe this has been a big bang approach by President Trump on tariffs. No matter whether they are rolled back or left in place in months to come, and certainly by the end of the summer, I expect that we will have resolved some of the uncertainty at least, and we'll go from there. So that's another interim happy hour podcast today to discuss what we've been seeing and some of the reversals in markets since Monday. And I'll see you again tomorrow live in Baltimore. Thank you.